Hello, here's another example of making journal entries, posting them to the T accounts, and then preparing financial statements. So let's get started. I need a pen. So shareholders contributed $10,000 cash in exchange for common stock. Remember, we are the corporation, so the corporation received cash of $10,000, so cash went up, so we debit it, and we credit common stock, which is the shareholders' equity account, which is increased by crediting it. So both the assets went up and the shareholders' equity went up, $10,000. In number 2, the company performed $8,000 in services, so they sold services, or that's revenue. They received cash of $6,000, so I'm going to debit cash for $6,000, the asset, and $2,000 receivables, so that's accounts receivable $2,000. So having a debit of cash and a debit accounts receivable totals to the credit to service revenue of $8,000. Incurred expenses of $6,000, paid $3,000 in cash, and $3,000 are still payable, meaning that we had expenses of $6,000. So we used or consumed that much. We paid cash already for $3,000, but we still owe $3,000. And remember, that's called accounts payable, meaning I have some bills to pay in the future. Purchased land for $12,000, so the corporation got land of $12,000. It paid cash, in other words, it paid $2,000 down, and financed the rest, which is a long-term note payable, which is a long-term liability for $10,000. So notice here the asset land went up, the asset cash went down $2,000, and the long-term liability increased $10,000. In number 5, we paid shareholders $400 in dividends, meaning we're going to debit dividends for $400, and we're going to credit cash, because cash is flowing out to the shareholders of $400, not $4,000. Sold one half of the land purchased in 4 for $7,000 cash, so we're going to debit cash $7,000. Now the land that we acquired in 4 cost $12,000 total, so if we sold half of it, I'm going to credit land for half of $12,000, or $6,000, and I see that this entry doesn't balance, and since I need another credit, it means that I sold the land at a gain of $1,000. In other words, I received $1,000 more than I paid for the land, or the cost of the land. Now the one thing we haven't done is identified whether they're operating, investing, or financing activities when cash is involved. And you'll remember in number 1 that if we're talking about shareholders' equity, and which is common stock, that it's a financing activity. And in number 2, if we're talking about revenue, then we're talking about an operating activity, because it's our day-to-day business to sell. In number 3, since we're talking about expenses, expenses are the day-to-day operations, so that's an operating activity for using cash. And in number 4, because there's land involved, that's a non-current asset, and non-current assets means it's an investing activity. And number 5, dividends, is a shareholders' equity account, so yeah, you got it, financing. And in number 6, since we sold half of that non-current asset land, that's going to be an investing activity, because it's a non-current asset, isn't it? And I should circle all those. Okay, so when we do the cash flow statement, we'll be good as far as the cash impact from these activities. So remember, we use the amount of the cash in these transactions. All right, what we're going to do now is we're going to post to the ledger. So we're going to debit cash. So I need a cash account. And we'll make it pretty big because there's a lot of stuff that happens about cash. Cash is increased by debits, decreased by credits. We're also going to need an account receivable account, which is an asset, so increased by debits, decreased by credits. Land, which is another asset account, increased by debits, decreased by credits. We're going to need accounts payable, which is a current liability account, increased by credits, decreased by debits. We're going to need common stock, which is the shareholders' equity account, and all shareholders' equity increased by credits, decreased by debits. Dividends, which is the special account. So I just always put a star over the debit side. As far as revenues and expenses, we have service revenue. Revenue accounts are increased by credits, decreased by debits. Expenses, which are increased by debits, and we try not to credit them. And we also have a gain, which is a revenue account, so it's increased by credits, decreased by debits. So let's post quickly. So the first one, we have a debit to cash for $10,000. And we have a credit to common stock for $10,000. And by putting a little 1 by it, I know the debit and credit go together. And number 2, we debited cash $6,000. We debited accounts receivable $2,000. And we credited service revenue $8,000. That was 2. So the number 2's an operating and number 1's a financing. I want to remember those. Item 3 was where we incurred those expenses. So we're going to debit expenses for $6,000. We paid $3,000 cash. So that's an operating activity, and we still owe $3,000. So that's accounts payable. In number 4, we purchased land, so land is going to go up $12,000. We paid cash of $2,000. So that's an investing activity. And we signed a note payable for the rest. So I think I need to set up a note payable account. Let's just put it over here. Note payable, increased by credits, decreased by debits. We are increasing it by $10,000, and that's number 4. Okay. Number 5 is we paid shareholders $400 in dividends. So dividends is being debited, cash is being credited, so that's a financing activity. And finally, in number 6, we sold half of the land for $7,000, so cash is going to go up $7,000 in item 6. That's investing because we sold half of the land. And we had a gain of the difference of $1,000. So those are how we journalized and posted those transactions. Stay tuned. We're going to put them into financial statements next.